Welcome to the Predictive Analytics Regression Classification class. This is lecture 9, first video part A. In this lecture, we are going to talk about an application of regression model. This is perhaps the most popular application of regression model. One of the popular application of this regression model is in the statistical finance or quantitative finance. The model in quantitative finance, this model is known as capital asset pricing model. It was first developed by Eugene Fama and later he was awarded Nobel Prize for his work. But when we see what is capital asset pricing model, we will see this is a beautiful application of regression model, a simple linear regression model. The purpose of the CAPM is to evaluate if a particular asset, say stock, is overpriced or underpriced or fairly priced. So the purpose of capital asset pricing model is to evaluate if an asset, say stock, is overpriced or underpriced or fairly priced. For example, suppose the price of Reliance Industry is rupees 2100. Okay? As an investor, you may have the following questions. Number 1, is rupees 2100 too high a price? If it is already very overpriced, what is the chance that it will drop? Second question, what if we invest these 2100 in rupees 2100 in fixed deposit? Am I going to, I have 2100 rupees in my pocket and I want to invest in Reliance Industry. I am hoping that by the end of the year it will go up. But is it going to go up more than what is my return from fixed deposit? If it can go up, but if it is going up not more than fixed deposit, I will be better off invest my money in fixed deposit. So this is what the idea. These kind of questions capital asset pricing model tries to answer. As we want to figure out whether the price of a stock will go up or go down, we need a baseline to compare. Suppose P0, P1, P2, ... Pn are the prices of stock over a time period. We would be interested to figure out the change in price over period from t-1 to t. Okay, so what we will do, we will just simply subtract pt-1 from pt and divide that by pt-1, and if we multiply by 100, that will give me the simple return. RT is the simple return of stock over period t-1 to t. This represents the percentage of change of stock with respect to pt-1. With respect to pt-1, what percentage of change has taken place in the price of the stock? So simple return is defined as simply pt minus pt-1 divided by pt. You can multiply it by 100 or without 100 is also okay, and RT, for the time being I am not multiplying it with 100. So RT is the simple return. Similarly, log return is defined as just log of pt by pt-1, and it is defined with small rt. So simple return I am denoting by big capital RT, and the log return I am denoting by small rt. Now one can show that simple return can be expressed as follows. So you can divide the both pt and pt minus 1 by pt minus 1, then you can write it as a pt by pt minus 1, and then you can write rt equal to e to the power rt by minus 1. So simple return and log return has a one-to-one correspondence. It is a one-to-one function effectively. Now here is a piece of code which shows how to download data. So what we are doing here, from 1st June 2022 to 30th December 2022, for 6 months, this is my start date and this is my end date. In the library T series package, there is a function get historical code or get.his.code. If you just give reliance.ns, then start date, end date, and give the adjusted close price and provider equal to Yahoo, if you give these values, so it will give you the data set for adjusted close prices of Reliance Industries from these days for 6 months. Now what you can do, you can compute the log return. Just simply take the log of the Reliance, take the difference will take the consecutive difference, and then compute the simple return, and then just C bind them. Then this column is essentially the log return and this column is essentially the simple return. And now if you can check it out, that these simple return and log return are almost same. The changes you will see after 3 decimal places, or typically 3 decimal places, or up to 2 decimal places. So there is a significant similarity between the log return and the simple return. Now we will define another concept called risk premium. Now what is risk premium? Risk premium is whatever the return minus RF, or RF is risk-free rate of return. Because during the same period you would have invest the same money in, say, fixed deposit of State Bank of India, then the return that you will, for sure you know that if State Bank of India says that okay, at the end of the time period I will give you 5% return, so these 5% annualized return is a guaranteed return. So naturally you would like to have that return if you want to averse completely the risk, because most likely State Bank of India will not default on its promise. So obviously you can have this risk-free return RF is kind of guaranteed. Then RT minus RF is the premium that you are getting because you are taking risk for investing your money in Reliance Industries. Okay, so here let's try to understand the example of risk premium. Suppose you invest your money in SBI's fixed deposit and SBI gives you interest income of 6%. Okay, by the end of the year SBI will give you guaranteed 6%. Now instead of investing in SBI's fixed deposit scheme, suppose you invest in the equity of Reliance Industries. Okay, so suppose the share price of Reliance goes up by 15% over a period of 1 year. So the risk premium is 9%, because 15% minus 6% is 9% is the risk premium. Now suppose share price goes down by 15%, then what is the risk premium? The risk premium is 21%, because you are not only losing 15% on your investment, you are also losing the 6% you could have earned if you would have invested in the SBI's fixed deposit. So risk premium is total negative 21%. Now the big question is, should we invest in equity or exchange traded fund? What is exchange traded fund? ETFs are a special kind of mutual fund. Typically it says that it follows a market index. Okay, so we have to model risk premium of equity as a function of the risk premium of the market. You have either three instruments to invest. You have three decisions to make. Either you can invest in SBI's fixed deposit, that will guaranteed 6% return, or you can invest in Nifty 50 ETF. That means if you this Nifty 50 ETF guarantees you a return of Nifty 50. If the Nifty 50 is an index of the entire market, if it goes up by 5%, it guarantees you return of 5%. If it goes down by 3%, it guarantees you return of -3%. So whatever the Nifty 50. So either you can overall invest in overall market, or a particular equity. Say you want to invest in Reliance or HDFC Bank or State Bank of India in these functions. Now capital asset pricing model is essentially can be explained as RT minus RTF equal to alpha plus beta times RTM minus RTF plus epsilon T. Now let me explain you what is RT. RT, this is RT, is the return of the asset or equity, or return of the, say for example, return of the Reliance equity. What is RTM? Here it is. What is RTM? RTM is the return of the market index, return of the Nifty 50. Okay. What is RTF? RTF is here. These two are RTF. Okay. So RTF is the risk premium of the return, risk-free rate of return. Risk-free rate of return. Say return from the SBI's fixed deposit. Say 6% guaranteed return. Okay. So what is it? Let us try to understand. So this means this is the risk. This is risk premium of Reliance Industry or equity. Risk premium of equity, particular equity where you want to invest, and this is risk premium of the market, risk premium of the market. Okay. Now what happens is, we can call this is the risk premium of the equity, this is the risk premium of the market, this alpha plus, so this is my response. I'm calling it, this risk premium of equity is a response, and risk premium of the market is my independent variable. So we are defining it as alpha plus beta times risk premium of the market plus epsilon T. In finance, this alpha plus beta RTM is called systematic part of the return, and epsilon T is called idiosyncratic part of the return. And the risk because of this part is called systematic risk, and risk because of this part called idiosyncratic risk, or the risk which we cannot explain. Okay. So we can express expected return, risk-free rate of return, as alpha plus beta times RTM, where expected value of epsilon T is 0, variance of epsilon T is sigma square, and covariance of epsilon T and epsilon T dash is 0. Now what alpha and beta means in this case? Suppose alpha is 0 and beta is 1.25. So it means if market return goes up by 1%, the equity return will go up by 1.25%. On the other hand, if market return goes down by 1%, equity return will go down by 1.25%. On the other hand, let us take alpha is 0 but beta is now 0.85. It means if the market return goes up by 1%, your equity return will go up by 0.85%. On the other hand, if it means if the market return goes down by 1%, the equity return will go down by 0.85%. So beta is measure of systematic risk. Beta is the measure of systematic risk. Okay, it is a measure of systematic risk. Okay, now let us try to understand what is alpha. What is alpha? Okay, let us try to understand what is alpha. Okay, we can express it as like this. Let us not keep this part is same. Now let us try to understand what is alpha. Let us fix beta as 1, beta equal to 1. Now if alpha equal to 0.01, it means if the market return is 0%, still equity goes up by 0.01%. That means even if market is flat, the equity has gone up. Why? Just pause the video and think about it. Why it will happen? If the market is flat, that means if market return is 0, that means market is flat. The market does not go up, but equity goes up. Why? Because the equity is intrinsically undervalued. More purchase pressure makes the price go up and hence positive return for the stock price, though market is flat. So alpha strictly greater than 0 means the equity is underpriced. The equity is underpriced. Okay. Similarly, if the alpha is greater than 0, then the stock is undervalued. If alpha is less than 0, then the stock is overvalued. And if alpha equal to 0, then the stock is fairly valued. Okay. Now I'm making certain assumptions. These assumptions are known as assumptions of efficient market. So no insider trading is allowed. Like nobody has any internal information and doing any trading with internal information. All publicly informations are already available, everybody, and easily accessible. There is no substantial tax, transaction cost, entry or exit bar. No limitations on long and short positions. This short position is bit questionable because in any market, it's typically they don't allow unlimited short positions. They do allow some kind of short positions, but not unlimited short positions. So under these assumptions, any non-zero alpha will be discovered very quickly by the people and they will position accordingly. As a result, what will happen? Alpha will go to 0. What it says that as soon as people will figure out that this particular stock is undervalued, people will start buying. Or as soon as people figure out this particular stock is overvalued, people will start selling. So as a result, very quickly alpha will go to 0. And the prices will become efficient. So under efficient market assumption, what happens is alpha is always 0. So expected RT becomes beta RTM, or expected RT minus RTF equal to beta RTM RTF, or you can write it as expected RT equal to RTF plus beta times RTM minus RTF. So the outcome of the CAPM under efficient market assumptions are, under the efficient market assumption, nobody will be able to make more return consistently than the market. This is the first thing. The best you can do is your performance will be at best average and similar to that of market return. So why invest in individual equity? You should invest in either mutual fund or market ETF. So that is what the efficient market typically propose. Let's look into efficient market assumption once more. So no insider trading allowed, all publicly available information already available. So there is no substantial tax, this is not right, and short positions allowed, that is also typically not right. So because of the deviation from the efficient market assumption implies price is not equilibrium anymore. A friction is being introduced, because if you remove those two, some friction is there. So maybe they're very small, but definitely alpha non-zero. So CAPM under the friction will be something like that, RTF plus a non-alpha plus beta times RTM minus RTF. So now what we do, we just do a test, we propose a test that null hypothesis alpha equal to 0 versus alternative alpha not 0. Alpha equal to 0 means stock is fairly priced and the market is efficient. Alpha non-zero means stock is not fairly priced and market is not efficient. Let's look into the data. Okay. So I have taken the data, Reliance Industries data between the 1st June 2022 and the 30th December 2022. So about 6 months of data I have taken. During the same time I have taken Nifty data also during the exact same time, and then I merged the two data set and calculated their log return. Okay, and here is the first few days of data of Nifty and the Reliance Industry, log return of Nifty and log return of Reliance Industry, and I plotted them over the period. So over the x-axis I plotted Nifty 50 return, log return, and on the y-axis I plotted Reliance log return. So there is a big outlier here where Nifty 50 is 0 but Reliance Industry dropped significantly, but most of the data you can see is sort of on a straight line kind of behavior we are seeing. And then we calculated the long return, fit the model, and this is the alpha, and this is alpha, and this is beta. Okay, and what we found that alpha p value is 0.3, t value is negative 0.881. So, and we have assumed that epsilon follow normal 0 sigma square. Okay, so based on that, so my test was not alpha equal to 0 versus alternative alpha not equal to 0. So if I assume alpha is follow normal 0 sigma square, the residuals follow normal 0 sigma square. Under that assumption, our p value is too high, 0.3, so we cannot reject the null. We cannot reject this null. So we can say that Reliance Industries price is fairly valued. It is neither overvalued nor undervalued. Okay, but we have to check whether the assumptions are correct or not. So the first assumption is what we check, that residual versus predicted. So there is a big outlier, but overall there is no much formation. So we ran a random test for randomness. We ran a randomness and p-value is very high. So null hypothesis is that the epsilons are random and epsilons are random versus alternate non-random. So here is the alternate hypothesis non-random, and we fail to reject the randomness. So looks like assumption of randomness is okay. Okay. Next, we tried test for heteroscedasticity. We just simply ran Bush-Pagan test, and looks like p-value is quite large, so we can homoscedasticity assumption is also okay. Then we looked into normality. So here is one big outlier, and there are quite a few points which is away from the QQ line. So we don't know. So we just ran a Kolmogorov-Smirnov test, and oops, assumption of normality is not correct. If the assumption of the normality is not correct, then we cannot do the test for whether it is correctly priced or fairly priced or underpriced or overpriced. That test is not valid anymore. So simple linear regression, though it's an application, capital asset pricing model is a simple application of simple linear regression model, but we cannot do the test for alpha because underlying assumption of normality does not hold good here. So how we solve this issue? In the next video, in the next lecture, we will discuss how can we use non-parametric bootstrap regression to salvage the situation of non-Gaussian distribution. And next video, we will do hands-on on CAPM, and after that, we will talk about bootstrap regression to salvage the situation of non-Gaussian distribution. CAPM is one of the celebrated model in the economics and finance, and this is one of the most beautiful application of linear regression in economics. It was done by Eugene Fama, and because of that he won Nobel Prize. So with this beautiful model, I will stop this video. I hope you enjoyed capital asset pricing model. Thank you very much. See you soon.